Good morning. I'm Kevin Price. Delighted to be with you. Going to talk to you today about you and your business, and we're going to get right into it with our weekly chat that we have been doing on mid-market size companies. You know, and there's always a lot of ink about the mega corporations. There's a mystique around those enterprise-level corporations, and of course, there's a certain romance behind the small businesses. But a lot of people can't even identify what a mid-market company is, yet they are so crucial in our economy. And so Marty Okner, he's an expert on this. He is the head of and the chairman of the largest chapter of one of the most important mid-market organizations in the world. And Marty, welcome to the show today. I'd like you to talk about that organization as well as the company in which you work for.
Wonderful. Thanks so much, Kevin, and really a pleasure to be on the show. So I'm chairman of ACG New York. That's the Association for Corporate Growth, and I'm chairman of the New York chapter. And basically what ACG is it's the largest association of middle market professionals focused on the middle market. So that's corporate executives, investment bankers, and private equity firms, and also debt providers that make sizable investments in the middle market to grow middle market companies and provide jobs for the American workforce. So we employ about 48 million people throughout the United States in the mid-market. And while a lot of the other companies were laying off professionals and during the recession, we actually added 2 million jobs. So really great story to tell, and really glad to be on the show to talk about it.
And real quickly, go ahead and give the website for both your company and for the association.
Sure thing, Kevin. So if you'd like to learn more about the association, you can log on to www.acgnyc.org. Once again, www.acgnyc.org. And in my company, I work for a firm, co-founded a firm actually called SHM Corporate Navigators. And what we do is we prepare companies for sale or capital raise, and also help them with growth strategies. And my website is shmcnglobal.com.
Very good. And your guest today, introduce him.
Great. Well, I'm really pleased to have Dennis Murray on the phone today, who co-founded the firm Murray Devine, which is one of the most premier valuation firms in the U.S. And you know, one of the things that a lot of mid-market companies need to do at some point, whether it's for gifting purposes or associated with a transaction or other initiatives that they may undertake, is to conduct a business valuation. So, welcome to the show, Dennis.
Good morning.
Hey, Dennis, welcome. Kind of give us the background a little bit about your company and what exactly you guys do.
Sure. Murray Devine is a national valuation firm specializing in valuing companies and their underlying assets. Our clients are located all throughout the U.S., some international work. And we offer the full array of valuation services, starting with fairness opinions, solvency opinions, valuations for financial reporting, all the way down to estate tax planning type valuations. Our companies are generally are of size of, as small as $50 million to certainly have experience in doing valuations for companies in excess of $1 billion. We've been in business. Murray Devine has been in business for 25 years, and we provide valuations and valuations only to avoid conflicts for our clients.
Very good. Marty, your question?
Great. So, Dennis, a lot of business owners, when they start thinking about selling their business, one of the things that they often want to do is really maximize the net after-tax proceeds of the sale. And, earlier, a couple of shows back here on The Price of Business, we actually had a wealth management expert who really said, it's a good thing to start gifting their businesses, shares of their businesses down to the next generation before they realize a transaction. In your expertise, when would a company really start, when should they start thinking about doing the business valuation? What does the process look like? How long does it take? And, when should they start planning on doing this, in advance of the sale of their company?
Yeah, good question. The process itself generally takes about 4 to 6 weeks to do the valuation exercise. But companies should really, once they start the discussions, of being on the same page and wanting to move forward on possibly selling their company, and that's the stage where they should start conversations. And then certainly the valuation firm should assist the company in requesting the kind of information they would need to value the company in the most accurate fashion.
Yeah, very good, very good. And I think people, particularly those who aren't in the, either in the mid-market or the enterprise level, I'm not sure they even quite appreciate how important it is that the work is that you do. I mean, you're really one of the key factors of whether or not a deal happens. Isn't that true?
We like to think that.
I would think that.
I would agree.
But it is a very critical component, and I think that, with all of the, news of, fraud and misguidance and, companies going bankrupt for, misfinancial reporting, I think it's so important to have an independent provider, assist the company in valuing the business and really kind of act as their kind of, right-hand man in the process.
Mm-hmm. Marty?
Yeah, so Dennis, there's all different types of valuations. You touched on them before. You've got valuations associated with fairness opinion. You've got gifting purpose for gifting and wealth strategy purposes. You also have business valuations to really get a good handle as to what the enterprise value of a company is. Now, what can you contrast some of the key differences between those types of valuations, for the listeners, so they kind of get a handle on what might be best to suit their purposes?
And by the way, we have about 30 seconds left. So if you can make it brief, that'd be great. I know it's a big question, but
yeah. I mean, I think quickly that the difference is when you're valuing a company for estate purposes, you're going to be looking at minority blocks of stock. So there's discounts that you would apply versus if you're going to value a company for sale, where you're valuing the controlling interest. Mm-hmm. So there is different steps that you take. The fundamental approaches to valuation are similar, but then there's just additional steps that you would have to take, whether you're doing it for sale purposes, estate planning, stock compensation. There's just additional steps of discounts that you would apply.
Dennis Murray, thanks so much for being our guest with Marty Okner. He's a regular here on The Price of Business. And do want to remind the listener that the best content here, including this interview, will be found over there at usdailyreview.com. While there, like it on Facebook, follow it on Twitter. And you're listening to The Price of Business.